The number on the screen has a minus sign, and for a moment your brain refuses to process it. $4. That's all it took. A coffee subscription you forgot about, a card that fired automatically at 6 a.m. while you were asleep. And now the bank wants $35 for the privilege of catching you off guard. This is where the story of money in the modern world actually begins. Not in a boardroom, not on a trading floor, but in the quiet, humiliating math of being a few dollars short. Here's the part almost nobody explains to you. That $35 fee isn't a mistake, and it isn't personal. It's a business model. Overdraft fees generate billions of dollars a year for banks, and study after study shows the same pattern. The people who pay them the most are the people who can least afford to. It's not a bug in the system. It's a revenue stream built on the assumption that desperation doesn't shop around. You call the bank. The hold music loops. A voice reads from a script and tells you the fee is final. This isn't incompetence, it's design. Every friction point you experience, every transfer to another department, every 48-hour promise of a callback that never comes is a filter. The system is quietly asking a question. How much frustration will you absorb before you give up? Most give up. That's point. And then the dominoes start falling in a way that feels almost unfair, because it is. The overdraft becomes a second fee. The second fee delays your rent. The delayed rent becomes a late charge. The late charge chips into your phone bill. Within a week, a $4 coffee has metastasized into $200 of cascading penalties, and none of it happened because you did anything reckless. It happened because the system is engineered so that being slightly behind costs you exponentially more than being on time. This is the part where it helps to zoom out, because what's happening in your bank account is a miniature version of something that happens to entire countries. Economists have a term for it, the debt trap, and it works on nations the same way it works on individuals. A country borrows to cover a shortfall. The interest on that borrowing grows faster than the economy that's supposed to pay it back. Argentina has lived this cycle for decades. Sri Lanka lived it in 2022, when the government ran out of foreign currency reserves and couldn't even import fuel. So ambulances sat empty and families queued for hours for cooking gas. The mechanics are identical to your overdraft. A small imbalance, treated harshly, growing faster than the ability to fix it. Back in your world, the hunger sets in quietly. Not the dramatic kind you see in movies, the quiet kind, the kind where you skip lunch and tell your coworkers you already ate. Nobody sees this kind of struggle because it's designed to be invisible. You've learned to perform fine. And this is one of the most under-discussed truths about financial stress. It doesn't usually look like crisis. It looks like normal people quietly editing their lives down, meal by meal, errand by errand, until the edits become invisible even to them. Then you walk into the branch, and something shifts in the teller's face. Not hostility. Something colder, recognition. You've become category. This is the human cost of what banks internally call risk scoring, a process where algorithms silently rank customers by profitability and reliability. You don't see your score. You just feel its effects in the tone of a voice, in how quickly someone stops making eye contact. Now stretch this a few months forward. You've clawed your account back to positive. $200, built from overtime shifts nobody applauded. And here's where the system reveals its second cruelty. The very act of having a small amount of money invites new fees designed for people who don't have enough of it. A $12 monthly maintenance charge. A minimum balance requirement of $1,500 that might as well be $1 million if you don't have it. You are, in effect, being charged rent to store the money you can barely keep. This is where credit enters the story, and credit is where most people first encounter one of the strangest paradoxes in modern finance. The poorer you are, the more expensive it is to borrow. A secured credit card asks you to hand over your own $300 as collateral, then charges you 24% interest to borrow it back. Contrast with a wealthy client who can access lines of credit at 4 or 5%, sometimes less, simply because the bank has decided the risk of lending to them is close to zero. This isn't cruelty exactly, it's actuarial math, cold and impersonal, but the effect on a human life is identical to cruelty. The tire blows on a Tuesday morning. There's no credit to fall back on. You ride the bus 3 hours late to a job that quietly starts looking for reasons to replace you. It's worth pausing here to talk about what economists call the poverty premium, a documented, measurable phenomenon where the cost of basic financial services is consistently higher for low-income people. Payday loans with triple-digit interest rates, rent-to-own furniture that costs 3 times retail, prepaid debit cards with fees for checking your own balance. None of this is accidental. Financial products are priced not just on risk, but on how much friction and information a customer has. The less time and legal knowledge you have to shop around, the more you pay. This is the invisible tax on being financially stretched, and it compounds in the same way debt compounds, quietly, relentlessly, in the background of a life that already has enough to worry about. Now something changes, and it doesn't happen because you worked harder or became smarter. 6 months of steady paychecks, $1,600 every 2 weeks, and the system notices, not you, the pattern. The maintenance fee disappears automatically. You check your statement 3 times because you don't trust it. This is one of the most revealing moments in the entire story. The fee didn't vanish because you asked, argued, or proved you deserved it. It vanished because your data started matching a profile the bank finds profitable. You didn't become a better person. You became better data point. The offers start arriving. Real credit cards this time, unsecured, sitting in envelopes with your name embossed in metallic ink. The approval takes 90 seconds. 90 seconds versus the months of rejection that came before it. This isn't inconsistency, it's the entire logic of modern lending laid bare. Banks aren't in the business of judging character. They're in the business of predicting behavior from data, and once your data crosses a threshold, the doors that were locked open on their own. Here's where it's worth understanding a concept from behavioral economics called anchoring, because it explains something strange about how we experience money. When your credit limit silently jumps $4,000 to $9,500 without you asking, your brain doesn't process it as the bank has decided I'm profitable. It processes it as I have more money. That subtle reframing from liability to resource is one of the most quietly dangerous illusions in personal finance, and it's precisely the illusion that keeps revolving credit profitable for the institutions that offer it. The industry doesn't expand your limit because you need it. It expands your limit because unused credit, sitting temptingly available, statistically increases the odds you'll eventually carry a balance and pay interest on it. Then the phone rings, and for the first time, a human being introduces himself by name, twice, and gives you a direct line. This is what the banking industry calls relationship banking. And the shift in tone tells you everything about how institutions actually value people, not by who they are, but by what their balance signals about future revenue. The same institution that put you on hold for 40 minutes when you had $200 now calls you first thing on a Tuesday morning when you have 15,000. Nothing about your character changed. The number did. And the number is the only language large institutions are fluent in. Widen the lens again, because this pattern, indifference below a threshold, warmth above it, isn't unique to your bank account. It's baked into how capital moves globally. Central banks and credit markets behave almost identically toward nations. A country with strong reserves and consistent GDP growth gets offered lower borrowing costs, more favorable trade terms, deeper access to international capital markets. A country in fiscal distress gets the opposite, higher interest rates precisely when it can least afford them, a phenomenon economists sometimes call procyclical lending. The IMF has faced decades of criticism for imposing austerity conditions on struggling economies at the exact moment those economies most need investment, not restriction. The system, at every scale, tends to reward strength and punish weakness, which is the opposite of what a genuinely supportive financial system would do. Back in your account, the loan comes through, $5,000 for car repairs, approved in 48 hours at 11%. It's not generous. Not Tory either. It's simply what the system decided you were worth at that moment. And this is the emotional core of the entire journey so far. Nothing about your intelligence, effort, or worth as a person has changed since the $4 overdraft. Only the number next to your name has moved. The bank was never evaluating you. It was evaluating a pattern of digits, and you happen to be attached to them. Fast forward, and the $15,000 mark brings something new. A private banker calling not because you asked, but because the system flagged you as worth retaining. Fees start reversing with a simple email instead of a phone tree. This is the moment the mask slips entirely, because it reveals a truth that applies to almost every large institution, financial or otherwise. The friction you experience when you have less isn't a resource limitation, it's choice. The bank always had the staff, the systems, and the ability to resolve your issue in 3 hours instead of 3 weeks. It simply didn't have the incentive to, until your balance told it to. This is worth sitting with, because it reframes something most people assume is just how businesses work. Indifference at scale doesn't feel like malice from the inside of the institution. Nobody at the bank wakes up intending to make a struggling customer's life harder. But the aggregate effect of 1,000 small, profit-optimized decisions produces something indistinguishable from cruelty when you're on the receiving end of it. Systems don't need intention to cause harm. They only need incentive structures that reward ignoring certain people and rewarding others. At $80,000, the language changes entirely. You're a preferred client now, a title that appears on your statements, your login screen, your banker's email signature. Your banker remembers a detail you mentioned 9 months ago, a sister in Chicago, and brings it up on your birthday. It feels personal. It's actually strategic. Financial institutions train relationship managers specifically to build what the industry internally calls stickiness, the emotional and logistical friction that makes a client reluctant to leave, even when a competitor offers better rates. Remembering your sister's city isn't warmth. It's retention engineering, and it works because human beings are wired to mistake attention for care. A pre-approval letter for a $400,000 mortgage arrives before you've even started house hunting. The bank has modeled your life before you've lived it. This is the essence of what's called predictive underwriting, and it points to something larger happening across the entire financial industry, the shift from reactive lending, where banks respond to requests, to predictive lending, where algorithms anticipate your needs based on spending patterns, income stability, and thousands of other data points you never explicitly agreed to share. The mortgage offer isn't a coincidence. It's the output of a model that has been quietly calculating your life trajectory in the background for months. At $500,000, the relationship stops being transactional and becomes almost theatrical. A wealth management specialist drives to meet you instead of the reverse. He carries a leather folder of printed reports and spends 90 minutes discussing your goals without pitching you a single product. This is deliberate. In private banking, the most effective sale is the one that doesn't feel like a sale at all. The consultation itself is the product, because a client who feels understood rarely shops around, and shopping around is the single biggest threat to a bank's long-term revenue from any individual account. There's a broader historical pattern worth understanding here, because the concentration of financial attention toward wealth isn't new, it's structural, and it has roots going back centuries. The Medici banking family of Renaissance built their empire not on lending to peasants, but on cultivating relationships with popes and kings, where a single loan could be worth more than thousands of smaller transactions combined. Modern private banking is a direct descendant of that logic. Serve fewer people, serve them extraordinarily well, and let the economics of concentrated wealth do the rest. It's more efficient, from the bank's perspective, to spend 100 hours cultivating one $5 million relationship than to spend 1 hour each on $100,000 accounts, even though the $100,000 accounts, collectively, might generate more total deposits. At $5 million, you stop having a banker and start having what the industry calls a primary relationship manager, someone who oversees fewer than 20 clients personally. Mortgage rates are no longer published numbers. They're negotiated in conversation. Paperwork that takes ordinary customers 2 weeks gets resolved in 48 hours, not because the institution suddenly became more efficient, but because someone, somewhere, flagged whose name was on the file. This is the mechanism behind an uncomfortable truth about modern capitalism. The rules that govern most people's financial lives are not fixed laws of nature. They're defaults applied to those without enough leverage to negotiate exceptions. The wealthy aren't breaking the rules. They're simply operating in a system flexible enough to bend around them. At $25 million, something even stranger happens. The relationship inverts. The bank starts asking you for opinions. A chief investment officer wants your read on emerging markets. A head of private banking asks what products your tier of client wants to see next. You've moved from being served by the institution to shaping it. This is the point where individual wealth starts functioning less like a bank balance and more like political capital, because at this scale, money and influence nearly indistinguishable. It's worth remembering that the same regulatory frameworks, tax codes, and financial products used by ordinary depositors were, in many cases, shaped in rooms exactly like the one you're now sitting in, by people whose feedback the system was built to listen to. Now here's the part of the story that should unsettle you the most, because it isn't really about you at all. Somewhere at this exact moment, someone is staring at a screen with a minus sign in front of it. $4 overdrawn. Coffee subscription they forgot to cancel. The fee is already processing. The hold music is already looping. That person doesn't know yet that the system isn't malfunctioning. It's operating exactly as it was engineered to. And the uncomfortable truth is that the same institution charging them $35 for being $4 short will, decades from now, if their balance ever crosses the right thresholds, fly a specialist across the country to ask for their opinion on global markets. This is the part that most financial content skips because it's uncomfortable and doesn't sell a product. The system isn't rewarding good decisions and punishing bad ones in any simple moral sense. It's responding almost entirely to scale, to pattern, to predictability of future revenue. A person with $200 and a person with $200 million can make identical decisions. Save consistently, spend responsibly, plan carefully, and receive entirely different treatment, entirely different interest rates, entirely different levels of human attention, purely because of where they started on the ladder. This has consequences far beyond individual frustration, because when the cost of capital is cheaper for those who already have capital, wealth doesn't just grow, it compounds asymmetrically. A person paying 24% interest on borrowed money is fighting against a current. A person borrowing at 4% is swimming with it. Over 10, 20, 30 years, that difference in the price of money becomes one of the single largest drivers of the wealth gap in modern economies, larger in many studies than differences in income from labor alone. This is why economists increasingly talk about wealth inequality not just as a moral question, but as a mathematical one, rooted in something as unglamorous as interest rate tiers and fee waivers. And this pattern doesn't stay contained inside personal banking. It echoes through entire economies during moments of crisis. During the 2008 financial collapse, the very institutions whose reckless lending practices triggered the meltdown were extended trillions of dollars in emergency support at extraordinarily favorable terms because they were deemed too big to fail. Meanwhile, millions of ordinary homeowners, many of whom had simply been sold predatory mortgages they didn't fully understand, lost their homes with comparatively little institutional mercy. The logic was identical to your $4 overdraft, scaled up to a global catastrophe. Proximity to systemic importance determines how gently the system your mistakes, not the size or nature of the mistake itself. There's a psychological dimension here too, one that shapes how entire populations experience inflation and economic uncertainty. When prices rise, wealthier households often experience it as an inconvenience. A slightly higher grocery bill, a delayed vacation. For households living close to the edge, the same inflation can mean skipped meals, unpaid utilities, or a spiral back into overdraft territory. This is why inflation, even when it's officially reported as a single national percentage, is never actually experienced equally. The number, uniform, the impact, not. Central banks setting interest rates to control inflation are, in effect, adjusting a dial that tightens around the people with the least room to absorb the tension. Geopolitically, this same asymmetry plays out on the world stage every time global capital gets nervous. When uncertainty rises, a war, a pandemic, a banking crisis, investors don't spread their money evenly. They rush toward a flight to safety, pulling capital out of emerging economies and pouring it into perceived safe havens like US Treasury bonds. The result is that the countries with the least financial cushion often see their currencies weaken and their borrowing costs at the exact moment global instability is already straining their economies the most. It is, once again, the $4 overdraft, replicated at the level of entire nations, punished hardest exactly when help is needed most. So what do you actually do with all of this? Sitting somewhere on this ladder yourself, watching the numbers on your own screen. The uncomfortable answer is that individual willpower alone rarely outruns a system built on scale and data. But understanding the mechanics changes how you play the game. It means treating credit not as a moral referendum on your worth, but as a tool with rules you can learn to read. It means recognizing that a temporary setback, an overdraft, a missed payment, a stretch of bad luck, is not a permanent verdict on who you are, even when the system briefly treats it that way. It means understanding that consistency, not perfection, is what shifts your profile in the eyes of an algorithm that was never judging your character to begin with, only your pattern. And there's something quietly radical in simply seeing the machine for what it is. Once you understand that the coldness at $200 and the warmth at $200 million come from the exact same institutional logic, you stop internalizing the coldness as personal failure. You start seeing it as a signal about how the system is built, not a verdict on your worth as a human being. That reframe alone, small as it sounds, is often the first real step toward climbing the ladder instead of being crushed by it. Because here's the final truth this entire journey points toward: the bank never actually changes. Not at $4, not at 400 million. The same institution, the same underlying logic, the same cold mathematics runs quietly beneath every level, indifferent to your effort, your intentions, your exhaustion. What changes is simply where you sit on a curve it built long before you ever opened an account. The question worth asking isn't whether you'll ever fully escape that curve. It's whether you understand it well enough to stop mistaking its indifference for your own failure, and whether, the next time a minus sign appears on your screen, you'll recognize the machine for exactly what it is: